Good afternoon, guys. Brett here, directors. Thanks for joining the live event today. So today I wanted to focus on credit scores. Everything about, what's the importance of a credit score from a mortgage perspective, how the scores are generated, things you can do to improve on, and maybe some of the myths out there for us. So first and foremost, guys, the credit score course is important in everything we do today, whether it's getting insurance, getting a mortgage, different credits that you are applying for and how that is. But a couple things I wanted to address is there's different types of credit score. So for example, when you apply with a mortgage lender, there's a certain algorithm, that's used to generate a score for a mortgage lender. That can be different than a credit card company, different than your mobile app, and different than, say, an auto company. So now, in general, they're all semi-similar to say, hey, the things that help your credit score improve are going to be across the board for all those different score types. But you may see one score, hey, I just bought a car and my score was X. That could be a little bit different than what a mortgage lender pulls, which could be a little bit different than what you see in your Credit Karma app. So I like clients to know that, say, hey, there is some expectation out there, and it's more of, hey, what's the general score, the trend of the score that's important for us. So that's kind of one key piece for us. So in general, I'm sure most of you guys have heard there's three main credit bureaus: Experian, TransUnion, and Equifax. Once again, they each have their own little algorithms of how they calculate a score. So even if we are pouring a mortgage score, for example, you're still going to have three different scores from each of those bureaus, and they may be a little bit different. So what we do is we simply use the middle score. It's not an average. We're just taking the middle because we understand, hey, if one of the bureaus is way off for a reason, we don't want an average to hurt you. We just take the middle score. Now, occasionally I see a client only has two scores. That's okay. We have two scores. We can still use the lower of the two. But that's kind of how we're going to pick what the score is we're using from a mortgage. So that's going to be a little bit of what types of scores are out there, what we're going to use of the three different bureaus as part of an evaluation for a mortgage. So the next piece for us, guys, is what influences credit. So there's a lot of things out there. First and foremost, do we pay our bills on time? This one's critical, especially things like a mortgage, credit card, car loan, any kind of loan that has a set payment, we got to pay it on time. How it works is if you're 30 days past due, then it's going to report in your credit to say you have a 30-day late. Then again, if it was 60 days late, it's going to now show a 60 or a 90 and continue. So again, if you miss a bill date by 1 day, that's okay, guys. Typically your creditor is not going to report you until you're 30 days past due. But that's critical. Now, I think it's awesome that there's all these auto pays and things out there. I use a ton of them myself, but I would always encourage you guys, check to make sure they go through. For example, if the auto pay set an amount and the bill changes a little bit, sometimes the auto pay doesn't automatically adjust. So I think it's important. I love having those, but I still take a quick look once a month to say, hey, just making sure all my payments, did in fact get made. So I would encourage some follow-up on that. But that's the biggest piece, of course, is are my loans and expenses that are on the credit being paid on time? The next piece for us, credit utilization. Personally, I think this one's a little bit goofy because, for example, I have a credit card that has a 10,000 limit and I want to use all 10 grand. I don't see why that should hurt us because you're just using your approved limit. However, it does. So it's goofy. So on anything that's a revolving loan. So a fixed loan like a mortgage or a car loan, it's fixed. The balance doesn't impact it. But when it's revolving, a credit card, for example, if you max that credit card out, it's going to work against your score. Now, here's the goofy part is if you have a credit card with a $10,000 limit and max it to 10,000, it's a 100% credit card. It's going to impact your score. If you have a tiny credit card of $300, max it out, it's still 100% usage. So even though it's only $300 versus 10 grand, the credit system looks at it as this is a maxed out or 100% card. So that's one of the simplest things sometimes is really looking at the utilization, especially on these tiny cards. If we have a few tiny cards, getting it from $300 to $200 in this example might go from 100% to 66% utilization. It's a massive change. So I would just be very, very cautious, guys, on any type of revolving debt to not see that thing maxed out. I understand there's going to be times in life where things are tight. We get to that point, but try as hard as you can to bring that down. So even going from 100% usage to 90% is a bump. Then the 80% is a bump. So again, bringing it down little by little helps, but keep that in mind as you are, making purchases or using those cards to really try not to have them maxed out. Even again, if it's like, it's only $300, who cares? Unfortunately, it's the 100% thing that hits us. Next one, credit history is important. So again, as you build this, if you're new to credit, that's okay if the score is not perfect right away. That's not going to be something we necessarily take against somebody as lack of credit history, but it's going to take over time. I got years and years or multiple accounts showing good payment history, good utilization. Your score is going to get stronger and stronger. So keep that in mind. Now, the other thing about, kind of credit history is sometimes individual trade lines. So for example, if you recently opened quite a few new debts and they were all less than 6 months, that may be evaluated slightly different. Once a loan's at 6 months old, sometimes it becomes a little bit more seasoned and builds into that algorithm a little bit stronger. So again, that's okay to open a new debt, but keep in mind, hey, my score may jump simply just by showing, hey, I have a new debt. I've now made 6 payments on it. It's somewhat seasoned. So that's one piece. Other than that, guys, those are the main key things for us to think about for you. Number of accounts can come into play. You don't want to have a ton of accounts, but ironically, like on the credit card, if you have one card maxed out, that's actually worse than having 3 cards at a 50% limit. So keep that in mind. I think the final thing I like to say on the credit score itself is inquiries. Now, I think this is something as a industry right now, people are hyper focused on, and I love the fact that people want to improve their score, but I think it's been blown massively out of proportion. So the fact that if somebody pulls your credit, you're going to see a major drop in your score, not the case. You have to have a lot of inquiries to truly damage your credit score. So I always tell clients, guys, the purpose of having a credit score is for a creditor to look at your score to help evaluate your options to buy something. Now, I'm not suggesting you go out there and have a million pulls. And, there's people that every time they go to the store, hey, I'll sign up for the Home Depot card, then the Costco card, then the Nordstrom's card. That's not good to have a ton of pulls or a ton of new open accounts. But if you're in the process of looking for a mortgage, buying a car, it is okay for someone to pull your credit. That's the purpose of it, is to evaluate what you can. So I say that because oftentimes, unfortunately, I have folks that are so nervous about having their score pulled that they wait and they wait and they wait. One, that makes it stressful for them. But secondly, if someone pulls your score at the very, very end, now there's not time to potentially fix something. So again, don't let that hold you back in a sense of being ultra concerned. Personally, I've done 4 or 5 mortgages in a year and never had an impact to my score. So just giving you a little perspective on that for us. Now, a couple different things, guys, to take a peek at to kind of help with, boosting that score that we talked about. As I mentioned, check the bills regularly. Super easy. I have 1 day a month. I run through, just make sure those bills get paid because that's the biggest piece. Watch the utilization as much as you can, track where those limits are, and try to say, I'm going to keep that less than that 100% as much as I can down to keep that utilization lower for you. Avoid having too many unnecessary accounts. But one caveat on that, if you have a card you've had for 10 years and you're like, I don't really use this card anymore, and you close it, as goofy as that sounds, that was a great history. You had a card with a low balance or even zero balance. I'd almost tell you to keep that open because it shows a good established long-term one. So occasionally cutting every single thing up and closing those accounts can work against us because that good positive credit is gone. Now, the last thing, I've mentioned a lot of things here of how to improve credit. The other thing is what's hurting against us, meaning derogatory items, late payments, collections. So I think that's one of the biggest things I see is, unfortunately, medical collections, rent collections, whatever those may be reporting against you. So I know there's multiple apps out there a lot of folks track. I often don't see, unfortunately, all those things show there. So that's sometimes why there's this variance. So I think it's important to whether you're inquiring on a mortgage, have the lender pull an official report to see if any of those things come up. Or you can go online and do the free annual credit report. The feds have put in some, laws saying you're allowed to get a free report. Those are going to be much more thorough than an online app would be. So you can check, is there a goofy collection? And unfortunately, sometimes it's the $39 collection from my insurance, that my insurance didn't pay a medical company. And it's frustrating, but if you can catch those, they can get resolved. It's just nice to know. So I would encourage taking a peek at those things at least on an annual basis. Other than that, guys, one last thing I wanted to mention. The credit bureaus have changed some rules to where now if a creditor, whether it's a car loan company, a mortgage company, a credit card, pulls your credit, the bureaus now, Experian, TransUnion, Equifax, will sell that information to a million other people. Unfortunately, it's super bummer for us to hear that. I think it's a little bit of an invasion of privacy to a point, but I like to tell consumers to say, hey, you may get a million spam calls. That being said, there's an asterisk here to help you out. You are able to opt out and say, I do not want the bureaus to be able to sell my information to any other companies for up to 5 years. And it's something you can continue to opt out with. So just as a fun kind of public service announcement today, I know it's one of the #1 frustrations our clients see. And I always talk to them up front is, guys, if you don't want to have your info out there for the bureaus to sell, click below. We'll have the link to opt out. And that way, hopefully it helps you whenever you encounter your next credit pull to not experience the goofy unlimited number of calls there. So thanks for watching, guys. Hopefully this gave some more context on some of the ins and outs of credit. As always, I'm always here for you. I'm more than happy to connect or shoot me a DM and happy to answer any individual questions on credits for us. Thanks a ton. Bye.